Good morning, good morning, good morning, everybody. Well, actually, good morning for me. It's 2 a.m. right here, starting the stream, kicking it off for you guys, especially a special FOMC meeting analysis right there. What we can expect, we're going to just cover everything around the FOMC, what we can expect here, the analysis we can do to look out for, such as the DXY, gold, the VIX, the indices, and so on. We're going to talk about the setups we can find there. And also, most importantly, we're going to watch Jerome Powell, our Uncle Jerome, live, having a conversation, talking about the interest rates right there. Looking forward to that, guys. We are crushing it in the morning, in the afternoon, in the evening, or in the middle of the night. We do not care. We are limitless. We can make this happen. So what are we going to do? We're going to do some analysis just before the meeting real quick. We should start it around 15 minutes from now. And based on that, we can see what we can expect right here. Okay? It's great to have you here. It's a little bit of a different atmosphere as well. Staying up all night, listening to the voice chat. Man, we have an amazing community right now. The voice chat is getting busier and busier and busier. The structure here is gonna get very, absolutely fantastic. I'm really loving it here. It cannot get any better, guys. Absolutely. So, who do we have in the building? Good morning or good afternoon, Vanessa. I hope you're doing well. Let's see if we can find a GU trade for you. I'm not sure. Let's see. Tony Gold says FOMC meeting. Let's go. What's up, my brother? I hope you're doing good, my man. Balta, UJ looking nice. Snoop in 007. Jamie, what's up? Our Jamie. Jamie, man, love you, brother. Marcus, Emmanuel, what's up, brother? Mr. Face, Golden Tips, Anisha, Gabriel, absolutely amazing. Edwin, John, Braden, Limitless Gain. Hey, you're back, my brother. Great to have you here. Danisha, good luck. Stick to your plans, everyone. Secure the bag. That's how it is. We're gonna look at all the charts real quick, guys. We're gonna do some top-down analysis there as well. Absolutely, alright. We're gonna make it happen. Sasa Bronis says good night in Indonesia. Absolutely. Okay, this is fantastic, guys. Alright. Let's dive straight into it. We have not that much time here before the meeting starts. We're gonna look for the opportunities. We're gonna look for the trade setups here. I have some. I did some, of course, some preparation here. Okay, so we don't need that much time here. But just to quickly, guys, the expectation of the potential rate hike is 3/4. All right. So that's 75 basis points right there. Okay, this is the expectation. That's pretty clear, okay? You never know what happens. It can always be higher. If it's higher, it's probably not priced in. Could give us a more volatile reaction to either sides, all right? I'm going to explain you guys exactly what I'm thinking about with the dollar index, gold, and so on. However, can get very wild. If it's 75 basis points, then that's fine. However, it's not just about the 75 basis points. It's about the questioning that will come afterwards, where people are going to start asking questions, where people are going to talk about the next coming weeks or months, ahead of us. What's going to happen? What's happening in terms of, the war and everything that's going on there and everything that's coming together. So it's going to get very wild, very volatile. We have to be prepared. My suggestion is that you are very careful with trading here. Okay, unless you're very sure or you're willing to lose whatever it is, right? And the reason why is because we can get very wild in terms of volatility. Even when you are in the right direction and eventually it goes to the direction you want it to, you can easily get wicked out. So keep that in mind right there, okay? This is going to be very interesting here. The question is, are we going to announce a recession or not? I don't think so. I think they're still holding everything positive. Everything is going to be fine. We're all going to make it happen. We're all going to relax. Everything is good. We're just going to inflate and then we'll see in the next couple of weeks, A lot of talking, but let's see what we can expect here. It's going to get wild here, guys. So real quick, the channels I'm looking at. I'm going to do real quick a top-down analysis before we actually start with the Bloomberg rate decision right there, okay? We're going to watch this live together. After that, we're gonna slowly have a look at the dollar index. Of course, we know that there is an inverted correlation between the dollar index and gold. So if the dollar index goes up, you can expect that gold goes down here. But potentially, let's see for that. We also have the VIX. Okay, the VIX is very, very interesting right here. We're gonna do a top-down analysis right now. Okay, purposefully, real quick. And the reason why I want to do that is just to give you guys a good understanding of what actually is happening here in terms of, you know, the VIX in general, because it's very, very interesting what's happening here. Okay, so what did we see? We came back down here. We created here a break of structure to the downside. One more time, a break of structure to the downside. Okay. After that, what did we do? We created a change of character to the upside. That was the change in momentum here. That was the change in the trend right there. We targeted this order block here. I think it's on the 3 hourly. Okay. We targeted that order block. We mitigated that order block perfectly right there. It was a rally-based rally. That specific order block mitigated into that zone and we took off from there. From that moment, we saw the continuation. Okay. Same thing happened exactly right there. We went up, boom, continuation, expansion, retracement, and so on. Okay. What happened here? Same thing. Break of structure to the downside. Change of character to the upside. Okay. Where are we now? We are now a little bit higher, all right? What can we expect here? Well, there are two things that we can expect. Either we come back up, of course, straight away, or we tap into that 62%. But I do believe that this area of inefficiency right there is crucial, okay? And this is all gonna align here with the dollar index. If the dollar index will come down here, then the VIX will come down, then the indices potentially will come up there, okay? So we have this zone right here. This is a crucial range we can expect from. However, if we look on the 4 hourly and we invert the scale right now, what do we see? Same thing right there. Okay. Change of character. Sorry, break of structure. Change of character right there. Okay. To the upside. There we go. What happened on the lower time frame? Exactly the same thing as what we're looking for, right? We saw that reaction from that zone. We came back up, came back down, tapped into that zone. However, this is an inverted scale, right? But it's just easier for you to show here right now. So if you see that, boom. This is what we're seeing right now. So we're seeing to resist. So the question is right now, are we going to come up here and then potentially come back down here towards this range? If that happens, very, very bullish news for the indices, okay? Very, very bullish news for the indices. So take that in consideration. Are we going to do this? Create that zone, create a higher high, tap into that zone. From that moment, start ranging again. And then potentially move forward for the next leg up. The overall trend is still bullish. We're talking about a short-term trend to the downside to fill up that inefficiency right there. Is that going to happen, yes or no? If we do break this zone, we are extremely bullish. And that would mean extremely bearish momentum for the indices right there. Okay? Extremely bullish momentum. So if we break this level right there, that means that we are extremely bullish. Okay? And that means that we are extremely bearish on potentially the indices right there. Okay, so let's take that in consideration. So let's have a look at the NASDAQ right now. Okay, we know what the analysis is right here. We have done the analysis right now. Okay, it seems that we're coming back down here, that we have created the chalk here, break of structure to the upside, change of character to the downside, retesting, and potentially now on the lower time frame can come back down here. That's my potential assumption right there. However, it all has to do with the meeting, with the news. Very, very hard to say, okay, this is 100% going to happen right now whenever we have meetings like this, okay? Very, very hard to happen, but this is the assumption right there. If you then look at the, you know, the NASDAQ right here, what do we see? Let's use the same tactic, okay? Let's go zoom out a little bit more. What do we see here? Same thing, right? We saw this coming down. We then eventually came up. We saw this whole range right there. Tapping into that zone, coming into the 50, tapping into this order block right there, okay? This was the reaction on the weekly, okay? We tapped into that order block beautifully right there. If you go to the 4 hourly right now, what do we see here? Let's turn it around. What can we see here? Of course, same thing here, right? In this case, we saw change of character to the downside. Change of character to the upside, okay? So is there potential downwards momentum? Yes, absolutely. We can definitely come down here. And as you know, the VIX is overall in still a relatively bullish trend right there. Okay, so that is the case. However, if we go into the 1 hourly right now, what do we see here? Okay, same thing happening. 30 minute. What do we see? Pretty similar. We saw the change of character to the down, break of stock to the downside here on the lower time frame right now. Okay? This is just market structure right here. Change of character to the upside right here. What happened? We saw the change of character to the upside. Okay. After that, what did we see? We saw the beautiful order block here. Respected, right? Beautiful, respected right there. Looking good. 5 minutes to go. I'm be quick. Right there. What do we see here? Liquidity. Okay? Liquidity is built over the last couple of days. This is a very, very, very good sign for us. Okay? The liquidity is mostly here. Okay? Yes, there is liquidity underneath. The liquidity is mostly here. You know what they do before major news releases? They build out liquidity. Okay? This is potentially the case what we're looking for. Liquidity is built. This can be very, very beneficial to understand. We know that the VIX can potentially short-term come down through our technical analysis, okay? We don't know for sure because of the news, but it aligns with the US 100. Why? Because all that liquidity is built up above this range here. So I do expect something like that to happen. So if you zoom into the 50-minute right now, same thing again and again and again. Lower time frame. We started at the weekly. We are now at the 50-minute, right? What do we see? Same reaction right there. Beautiful. Let's go closer right there. Do we see an order block? Yes. What kind of order block? 10-minute order block. Bullish, bearish, bullish. Boom. Do we see that reaction? Fantastic. Absolutely we see that reaction. Look at that. Tap into that zone. And we took off from there. Going for the liquidity. So any retracement right now, personally, I want to go long here. Okay? Looking for a particular zone right there to enter potentially. I'm talking about the lower time frame here. Okay? Change the character to the upside confirmed. So what do we want to see? Want to see zones like this on the 10-minute right there. These type of candles right there. Bullish, bearish, bullish. Potentially coming into that zone. I would potentially tap into that area. If news comes out right now, come back up, come back down. I would potentially look for long depending on the news release right there. Okay? That's the indices I'm looking for. We took it from the weekly. We are now all the way down at the 10-minute, okay? Go to the daily. Go to the 4-hourly. What do we see here? Go to the 1-hourly. What do we see here? Everything is aligning, right? All the order blocks aligning. Liquidity is built above that area. This is where we're heading towards right now, okay? Very, very interesting. The indices, potential, if we go for an opportunity, potentially long opportunity right there, okay? Short-term, long opportunity. Go for the liquidity. Go for these zones right there. The other reason is, one more reason. The previous daily high. Also, the previous daily high and the previous weekly high as well. That's the potential goal. What can we do there? There's a big chance that we can come up to that range right there, okay? If things are turning out fine. However, we need to see if it aligns here with the VIX completely as well. That's the one thing. We have 1 minute to go. Let's see what we're doing here.
But that you are going to see a little...
Nothing spectacular yet. Okay, let's go to gold. Gold also. Very, very interesting. What do we see for gold right here? Okay. Break of stocks to the downside. You guys know it. Change of character to the upside. Is there an order block that validated that structure break there? This is the 30-minute. 1 hour. 50-minute. Absolutely. Look at the order block. You guys know it. Bullish, bearish, bullish, right? Drop base rally. What do we see here? Let's zoom out here. Boom. Perfect reaction from that order block. Okay, we're on to something right here. Where is the liquidity build? Same thing, above that range right here. Okay? There we go. Let's zoom in. 10 minutes right now. What do we see? We came back down right there. We tapped into that zone. Break of stock to the downside. Change character to the upside. We came back down. Where did we tap in? Into an order block right now. Okay? We are in that order block right now, right here. It's gonna get very, very wild. We see that people are already buying it up right now. I would not go long whatsoever. We can easily go through it. Easily. Okay? Why? Because it's 2 o'clock. Let's start it. I think we're gonna start any given moment right here. However, the analysis for gold is the same particular thing. Why? We have to see exactly what will happen. Okay, the last one is the DXY. DXY is going crazy right now. DXY is going completely ham. Okay? So it's 0.75.
we can head to DC.
Let's see if it's here. Not yet, not yet.
Expecting by 2023. By 2023, I was expecting 4.4 to 4.6. The Fed just came in with a dirty number. Oh man, the Fed actually came in with 4.6 right here. So I was right on the upper end here. Finally, the Fed's putting some pants on. Stocks turning negative right now. The Fed anticipates that ongoing.
Okay, dollar strong, guys. Dollar strong. Gold weak. There we go. The up. Okay, this is very, very interesting. Like here, let's see what we can expect right now for the VIX. Okay, the VIX is gonna be very, very interesting here. Oh yeah, dollar index is pumping hard. You know, it's a pyramid here. Let's see if we're gonna have a talk right here as well. Where's Uncle Jerome here?
Point to modest growth. That is an.
Okay, it's 75 base points, right? However, it's about the long-term expectation right there. This is what we're looking for here. Okay, it's coming. Okay, the meeting is in 30 minutes. All right. Okay, okay. Okay, that's good. There's enough time to do some analysis here. Okay. This is why we have to be very, very careful. Okay, the DXY is going ham right now. Why? Because the expectation here... Let's go back to this guy. He was actually talking facts here.
Welcome back.
Let me see where this guy is.
What is his tone? Right, is he gonna...
Where is he? That's actually pretty good. Let me check. There we go.
Summary of economic projections, but we do have the actual data coming in. Oh, whoa! The 2-year treasury yield just jumped to 4.11. Oh, man. Okay, let me take a look here. I want to see what's going on with the 10-year too. That's bad for real estate, folks. But hey, what's bad for real estate is good for house hack because we're going to get some better deals. I know that sounds terrible because it basically means I'm expecting home prices to fall. But let me be crystal clear. I've been talking about home prices falling since January, okay? Like, I've given plenty of warnings. Anyway.
All right, this is interesting.
Holy crap. The 3.6 on the 10-year treasury right now. Absolute devastation. 4.15 on the 2-year. This is insane. Stock market now down 0.5%. Look at that plummet on
Wow. Okay, there we go.
Almost down a full percent. This is terrible, especially for real estate stocks. Open door down now 5 percentage points. Look, I hate to say that I came in hot on the expectations for that summary of economic projections. I ended up being right on my expectations for that, but I have to say, like, this is what's needed. The Fed should have put on the big boy pants in June. They didn't. And then we got a 9.1% report. And now they're finally putting on the big boy pants and they're like, yeah, no, okay. We need to go. Okay, there we go. I have the actual SEP now. And so let me airdrop that over. But I've already been reading off the SEP because I have another source for it. I just want the actual PDF. Okay. All right. So here comes the new SEP. Woo! Oh, come on, man. I don't know. I'm just really proud of myself. Again, it's sad, but I can't help it. But look, my estimate was in red, okay? 4.6% and 3.9, okay? Then
4.6 is high, guys.
To the new table, what did we get, folks? What did we get? And the calendar has moved over one because they added a new year, 2025. 3.6 and 3.9. Come on, man. Nobody covers the Fed better than us here. Thank you for watching. Okay, let's see what we got. Holy crap. Look at that change in GDP. Oh my gosh, this is terrible. 2 for GDP. Finally, the Fed puts on the big boy pants and admits that we're basically close to a recession. Finally. Yeah. Finally, they admit it. Finally. Now, they actually think GDP is going to go up to 1.2 and 1.7% in 2023 and 2024, but they have completely crushed their expectation of what GDP would be doing. They told us in June, oh, don't worry, we'll be far away from a recession with nearly a 2% GDP. Wrong. 0.2% is the current expectation, basically teetering on recession. And we are already technically in a recession. However, GDP could be revised up, right? But that is a huge revision to the downside on GDP expectations. Okay, let's look at the unemployment rate. So the unemployment rate did not rise as much in the Fed's view, did not rise as much as Kevin projected. Kevin projected on an unemployment rate that we...
Okay, real quick, guys, real quick, just to give you some absurd here. Very easy. Look for a break of structure to the downside, right? A break of structure to the downside, then a change of character to the upside. Okay? What did we see here? I mean, I know that this is the XY, but just an example. Okay? We saw that reaction here. That change of character was created. Okay, boom, higher high. From this moment, what do? Okay? You draw swing high to swing low. What do you see there? You see a beautiful order block right here, right? Look at that beautiful candle there. What happened from this moment? Look at that. There we go. Break of structure to the downside, change of character to the upside. And here we are, right? That's how you can catch them. That's how we can catch these setups right there. From the monthly to the weekly to the daily, for hourly to determine the bias we are looking for right here.
Actually see an estimate of 6.8 is 2.5%. Jerome Powell told us we would go to neutral, maybe slightly above. Okay, this is now 2.1% above before we actually peak. And no guidance in terms of when we'll actually come down, just that it'll be hopefully by 2024. Now, what I do want to look at is the ranges, okay? Look at this, folks. Look at the range. So central tendency and range. Okay, so central tendency is more of an average. I want to look at the range here. So the range for hikes shows that almost everyone at the Federal Reserve believes that rates are going to go to 4% or above as a terminal rate for the Fed. This could be one member saying 3.9%. And we'll look at the dot plots in a moment to see that range and see clearly what's going on there. But that's interesting to me, is that the Fed is very unified here in this approach that, yeah, no, like we need the terminal rate to go above 4%.
Smash that like button for Jerome. Appreciate you guys.
The actual FOMC statement on the vote to go 75. Voting for were Powell, Williams, Barr, Bowman, Brainard.
All right, so the expectation for 2023 is a 4.6% interest rate. All right, that's extremely high. That's extremely high. What will happen? It's going to become very expensive to borrow money. This will have a massive impact on the overall economy, okay? Understand that when people cannot borrow money or it's extremely expensive to borrow money, you know, and the returns are getting less and less because the stock market is going down. Because of that, it's gonna get very hard. We're living in a huge society full of debt, right? Everything is based around debt, around paying back your money that you borrow. Everything is debt. Everything is credit, right? So this is massive right here, okay? This indicates that we're finally, or at least almost looking towards finally that confirmation officially that we potentially are in a recession. We all know what's already going on here. We all know it's unavoidable, right? But it's about that official statement from them telling us we are in a recession or we're very close to a recession here.
Bullard, Collins, Cook, George, Jefferson, Mester, Waller. All 12. It was unanimous. All 12 board members said 75. Yesterday, the Wall Street Journal, and I read the newspaper, okay? I read the live stuff that we see on the internet, but I also read the newspaper. And in the newspaper, the Wall Street Journal would kind of put a thing up, and they're like, this is how the FOMC statement could change. They actually thought that 2 board members were going to vote no to 75 and go for 50. Wrong. every single Fed board member went for 75 on this one. Big deal. Okay. Now, let's go ahead and look at the ranges, but I'm getting a lot of comments here from members on the channel. Thank you, by the way, for being a channel member. It really helps us cut down on spam in these comments. I can actually look at them and read them and not have to worry and get distracted about spam. I'm getting a lot of comments from folks asking that we look at BTC. It looks like BTC...
We're not done yet, guys. We are not done yet. This is just the beginning, okay? This is the initial reaction.
Because that's where we were teetering yesterday. We did rally a bit up to about almost 20,000, that 19.8 level. But we are seeing somewhat of a little bit of a recovery right now in the stock market. This kind of damage could quickly get undone when Jerome Powell actually goes to speak. DXY just shot up to 111. That's insane. But it makes sense. Oh my gosh. Yeah. So this makes sense because as interest rates for risk-free money skyrocket in America, oh my gosh, yeah, the dollar skyrocketing. The dollar strengthens because remember, when you offer 4% risk-free, and look, I'm becoming a licensed financial advisor. As far as I'm aware, the only thing that you are allowed to call risk-free are treasury bonds and notes, right? That's it. And you know, when the international community can look at the 10-year treasury at 3.6%, or a 5-year treasury at now 4.1%, that's pretty awesome. That's like a pretty nice yield. So what do? You buy dollars. When you buy dollars, you sell your country's currency. So if you own euros, you're like, dump this crap, I'm buying dollars. And that's how you get to the euro being worth less than $1 now. And then people can buy bonds, or corporations can buy bonds in America. It's quite incredible. So this pushes up. Okay, so remember, the Federal Reserve Fed funds rate does not directly correlate to what interest rates are on mortgage rates or the 10-year treasury. The Fed funds rate is the rate that banks, under the sort of supervision of the Federal Reserve, lend money to each other on an overnight rate. That's different from the discount window where you can borrow from the Fed. And that rate affects a lot of things: credit cards, car loans, mortgages, everything. But it's not a one-for-one move because the market actually prices treasury yields. And the market tries to anticipate what the Federal Reserve is going to do. And so when we get kind of a little bit of a rug pull here, okay, a little bit of a rug pull on that rate move, but it was necessary, okay? Look again at the projections. So look at the projections here. What do we got? These are the projections for the FOMC. Kevin is in red. The Fed and what we actually got is in blue. And Wall Street expectations are in orange. And you can see Wall Street did not think the Fed was going to put on their big boy pants. The Wall Street thought we were going to be sitting at, 4.1% for the
USD cut is interesting.
Rate, and then 3%, 3.6% thereafter. Sorry, we beat that. Finally. Welcome aboard, new members. Car for Coin. Efrain, thank you so much for joining. Government won't be able to service their debt soon. This is untrue. So if you actually look at the, well, here, let's look it up. Centless Fred, debt payments, debt service payments, United States.
All right. So let's go over the current analysis real quick. It's extremely interesting here what happened. Okay. But we are not done yet. Okay, this is the first layer right here. Okay, this is the first step. This is eventually what we saw here. Okay. So the interest rate projection for the first year Q3, 4.6%. That's extremely high. Okay. We are now at a 3.25% rate hike. Okay, we have to take that in consideration. We can still use the interest rate differentials right now. Okay. This will push the price up no matter what. All right. Whenever the interest rate from different currencies is bigger, right? So let's say the US dollar is now 3.25 and the ECB, the European Bank, is still 0.5. It's a bigger gap, right? It was 2.75. Right, or 2.5, sorry. So the gap is bigger. So right now we have to take that in consideration as well, that they potentially want to push price further down for the euro against the US dollar here. So I saw somebody talking about the question for this potential, channel right here. What can actually happen? You're in a profitable position right now. What should I do with the euro USD? This is completely your decision, my man. This is completely your decision. I do not want to have an influence on your decision here. Okay? Great that you're in profit. In the long term, the next quarter, I think the goal is to push the price further down. Especially if the ECB not decides to, the hike to interest rates right there as well. However, for now, we have still a lot of news coming. Alright? Okay, DXY is now slowly coming down here. The VIX is still in this order block. The VIX is still underneath that order block right here. The question is, are we going to go further up and are we going to skip this area of imbalance here underneath that zone? That's the question right here. Okay, yes, we have created a change of character to the downside. Break of stock to the upside, change of character to the downside. So we should expect some resistance here. But we have been, we see that resistance already for, the last couple of days right now. Okay, so let's take that in consideration here. We can expect a lot of resistance right here. Okay, so that's number one. The next layer is, of course, the indices. Let's have a look at the indices real quick. Let's have a look at gold real quick. Okay, in the meantime, the USD CAD is doing very, very well. And it's leaving us with a very, very good opportunity as well right now. The top-down analysis for the Canadian dollar USD CAD is extremely bullish, right? Extremely bullish. We still solid reaction right here. Beautiful reaction from this zone. And we just took off from there. So we were waiting for the retracement here to continue the way up here. I think in 10 minutes we have the FOMC meeting, the actual meeting right here. So let's do some analysis here. What do you guys want to see as well? The question is, do they want to reverse price back up right now? Do they want to reverse price back up? Send people in one direction to then do the other thing right now. So let's have a look at the VIX. The VIX is still holding here. That's quite interesting. All right. We have not created our high here. Let's say here. We are still underneath that zone. That's quite interesting right here. The XY, of course, is going pretty ham right now. Okay. Let's have a look at the US30. Took out the levels here. US 100 took out the liquidity here as well. Alright. We came back up. We reversed price back down here. What are we gonna do now? We have taken the liquidity here. The rest of the liquidity is above that range right now. Are we gonna retrace back up? We need to go to the lower time frame. We need to wait for reaction from this zone here. If the DXY comes back down right now and the VIX is holding, we can still expect something decent for indices. Potential retracement right there. Gold indeed probably took out the lows as well. With the DXY moving like that, we have to be very, very careful with trading. Everything was super respected, right? Break starts to the upside, change character to the downside. We saw the beautiful reaction here. Could have been a beautiful trade, by the way. Today. Could have been a very, very nice trade here. This was a, like a 4-to-1. Okay. Before we finally reverse back down. So now we are here. We have taken out all the lows, all the liquidity from that range right there. So what's next for gold? Alright? What's next for gold? Well, of course, it was a massive liquidity level. Yesterday, we did not take out the previous daily low and not the previous daily high. We were ranging completely in the center right here. So finally, we have seen some action right now. So now we have taken out the previous daily low and the previous weekly low. I think the goal right now, in my opinion, is to come back up here. Potentially cover the wick, come back up and to see the previous daily high here. And at least target the liquidity above that area. I think it makes more sense right now to look for these ranges right now and to potentially the DXY to cool down a little bit and to potentially, at least short term, you know, come back down at least a little bit here, but then potentially continue the way up further. Okay, is there a big chance we keep going after we have come down? Of course, yeah. Continuation is the only thing what we are looking for. All right. Okay, we have taken out the previous daily low and the previous weekly low here. We have the meeting right now. Like we said before, before the stream, we do not recommend you guys to trade this. We can only indicate potentially where the liquidity is built and what they expect it to do. But with this rate hike here, it's gonna get very, very interesting. Let's see what he says right now.
Now what we're waiting for is a Federal Reserve Chairperson Jerome Powell's press conference. That press conference is going to begin in about 8 minutes, right? So we're going to go ahead and write down here that 11:30 Pacific, Jerome Powell speaks. Okay, so, you know, we have this question here that says, why is everything selling off when the market got exactly what it expected? Well, your answer is actually very, very simple. The market was not concerned about whether or not we were going to get a 75 basis point hike. That was not the concern. The concern was actually what the summary of economic projections would say. And the summary of economic projections, unfortunately, gave us a disaster. They gave us a terminal federal funds rate that was substantially higher than markets anticipated. Markets were expecting the terminal Fed funds rate would be about 4.1%. It actually came in line with the upper end of my personal estimate of 4.6%. Finally, the Fed is putting on the pants and saying, no, we're going to deal with this. This is actually a good thing because it means the Fed is quite frankly being honest with us. Whereas in the past, they haven't been that accurate. I want to remind you of how terribly inaccurate their projections have been in the past. Their FOMC statement in December, for example, was a complete disaster. And when they had to U-turn on that, it became clear that the Federal Reserve had as little clue of what was to come as we did. We were all quite blindsided, quite frankly. And so that's bad, right? When we're blindsided, we end up seeing markets adjust and fall. So, for example, if I go to the December 2021, I want you to see this, okay? December of 2021, I have it right here. This is the Fed statement, December of 2021. The Federal Reserve projected that at the end of 2022, the federal funds rate would be 0.9% in green, and that it would go to 2.1% only in 2024, folks. Well, what ended up happening? We ended up getting a Fed funds rate that is expected to go to 4.6% next year. That's more than 3%.
We got fooled, guys. We got fooled here. All right.
Points higher. And the Fed came in with a terrible GDP projection. Yikes. Yikes, yikes, yikes. Is xauusd going to pay dividends? It's a good question. This is a growth company. It's not starting as a REIT. And the answer initially is going to be no. We will probably outline some form of dividend plan in the future, but right now the goal is to get to IPO with xauusd. I receive no compensation, no bonuses, nothing unless we IPO xauusd and the original investors in the company get a double on their money. That's our current, and we're finalizing that stock comp plan. But basically, myself, my wife, we get paid nothing until this company IPOs and the original investors have doubled their money. And really, we hope that would be like a minimum, right? But we can't guarantee that. But anyway, learn more, obviously, by going over.
Guys, the manipulation is so insane. Think about it, man. They're saying that they potentially went for a 0.9 up to a 2.1 in next year. We are already at 2.5 right now. We're at 3.25, right? What does that mean? What do they really say here? Are they saying, you know what? Let's tell the crowd that we're just keeping it very low so we can back off. We can do our own thing here. We can make sure that we are prepared, and then we actually do the opposite. What do you guys think?
To househack.com. All right. So let's see here. We have 5 minutes to go before Jerome Powell comes. Fed was basically gaslighting us to avoid a crash. That's somewhat what it feels like. Absolutely is what it feels like. Is there a minimum to invest? So the minimum to invest in HouseHack is $25,000 for accredited investors. We are hoping, but I can't guarantee this. We're hoping to get to $5,000 for non-accredited. Although I can't promise that. It could end up being 10. It could be 25. I don't know. I want to make it as accessible as possible to everybody, but it's out of my control at this point. But I'll let you know as soon as we have a certain answer. The hope is to make it very reasonable for people, but it's definitely not going to be less than 5K.
It's absolutely incredible, guys. Like, I spoke with one of my friends from the Netherlands yesterday on the phone. We had a conversation, all right, about life. He's one of my best friends. I haven't spoken to him for a while. I said, man, what's up? How's it going? He said, yeah, bro. The gas prices in my country went up 6 times than it actually was, right? Electricity went up with 90% as well. Petrol went up. It doubled. All right? It doubled. The Netherlands is one of the most expensive countries to drive right now. In terms of, you know, the petrol. I don't know, you guys calculate a little bit different in the United States, but we talk about liters, right? For 1 liter right now, we are at what? Almost like 2.7 euro. That's like what? $2.8? $2.7? Something like that. $2.70 for 1 liter. All right? It's absolutely wild right now. Things are gonna get very, very messy here. People cannot, you know, they just cannot do it anymore. Right? A lot of people that I know, a lot of families that I know, a lot of people in my country having a very, very, very hard time. The mother is working, the father is working, right? The man of the household is working, the woman of the household is working, and they just cannot make it happen. They cannot make it happen. Can you believe that? I feel it's absolutely incredible. Things are gonna get way, way, way worse. So my suggestion is go to a country where you still have some room, all right? Maybe a country that's a little bit more corrupt, you know? So you have a little bit more freedom. Like, I don't know. I cannot, you know, we have to talk in Discord a little bit deeper here. Anyways, things are gonna get very wild, guys.
75 and 50. It's actually a good point. I'm gonna write that down. Yeah, we got the GDP low estimate, and then we also have the path, which is 75 November, 50 December now. The 100 was off the table for a while. I don't know what hangover of ownership. Will there be any overhang of ownership since you were the one starting house?
Okay. Look at that reaction, guys. Immediately bought up here. Okay? What does this indicate? This indicates a massive liquidation hunt right there. All right? Took out the previous weekly low, took out the previous daily low right now. So the question is, what are we gonna do here? All right? What are we gonna do now? Are we gonna create a higher high right now? That's the question here. Are we gonna break these highs? If we do break these highs here, we could potentially start looking to turntables here. I would not trade anyways right now. I would let things settle here. Completely be patient, let things settle, and just see what we can do. Whenever the volatility is decreasing, we know at least what the, you know, the midterm reaction will be right now, what the midterm expectation will be. This is what it's all about right now. What is the mid to long term right now expectation we can look at, so we can re-engineer it or reverse engineer it back down towards the lower time frames and see from there. Okay? This is what we need to do right now. So therefore we need to be patient. I highly recommend you guys to just be a little bit patient here. Let's see what Uncle Jerome is telling us today. All right? And let's see if we can find some opportunities there. We have around 5 more minutes for the news, I think, to come here. All right? 5 more minutes to go. Bjorn says, he's Dutch, he says, electricity times 4 with a new contract. 4 times the electricity bill. I agreed to move to my husband's country, Senegal, and raise our baby. Amat is absolutely insane. Jente says Fat beat to start. Yes, we're coming right now. We're starting in a matter of seconds here, guys. Alright. Go Workout says, ATM trading feels like gambling, but it works. I think last trade for me. One short again on the eurjpy and finish trading for today. The news is already there, my friend. The conference is gonna be very interesting. Liquidity Hunter. Hope gold falls some more. It definitely fits your name, my man. Anita says, I think it's time to move to Bali or Fiji. I mean, there's always rice here. There's always rice. Positive said, thank you for analysis, learning a lot. Thank you, my brother. I appreciate you, man. We have to be very patient here. We cannot make, any impulsive decisions here. Whatsoever. Lorenzo, can you look at the DXY on the 3 minute? Yes, let's have a look at it. There's USD cut, by the way. Yeah, we did a top-down analysis for the USD cut. We can talk about it later. Okay, we're starting any moment, guys. Oh, look at that reaction here. Liquidity hunt. Okay, we broke the highs, guys. Wow. We broke the highs for gold here. Okay? We broke the highs for gold here. This is very, very interesting. Okay? We took out the highs here. Wow, 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 wow. Alright, alright, alright. Look at that. Look at that, look at that, look at that. Swing low to swing high. Once you have once you know exactly what the structure is, where the break of structure is, you can use the Fibonacci. Swing low to wherever you end up here. Okay? 50%, the equilibrium here. We have that 3-minute order block sitting there. We have the change of character there. Change of character. We took out all of that liquidity underneath. Like I said, we took out the previous weekly low and the previous daily low here. Immediately aiming for the liquidity above that. What a reaction, guys. What a reaction right here. Let's go real quick to the indices as well. Wow, wow, wow. Same thing. Very, very similar here. Okay? Very, very similar here. These are the highs right there. These are the highs. It's all about looking for the highs right here. This is massive, guys. Wow, 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 wow. Okay? Look at that reaction here. We have 30 seconds to go. Smash that like button, guys. Highly, highly appreciate that. We're gonna cover it. It is 3:30 a.m. for me. Was waiting all night for you guys to do this together. All right. We broke the highs here. Very, very interesting. We've seen that order block here. Also very, very interesting right there. Okay. The order block is at, I think, right now, The 62%. I'm not gonna trade this, okay? I'm personally not gonna trade this. But I just always want to keep doing the analysis here. And look for the setups here. So what do I see here? We took out the previous weekly low and the previous daily low. We created a change of character on the lower time frame. Right now, we immediately took out these highs here. We took out these highs here. Created a change of character here. If you draw the Fibonacci from swing low to swing high, we are at the 62% here. So we are in the premium area of demand on the lower time frame. We have that order block sitting there. Very, very interesting, guys. So that's gold. Same thing for the dollar index here. Okay? Same thing for the dollar index. Wow. That's wild. That's wild. That's wild. Wow, 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 wow. Okay. Wow, for gold, yes. All right, and the indices right here. Look at this. Look at this candle here, guys. Look at the liquidity that was built up underneath that zone. All taken out. All the stop losses that were built here. All taken out right now. So now this is taken out right now. And we have that talk with Uncle Jerome. Question is right now. We have not taken out these highs here. Okay? Are we gonna come back down here to tap into that zone first? Okay, that's the question. Or are we just gonna come lower here? Let's have a look at the VIX. The VIX is coming down, right? The VIX is coming down. This is good for the indices right here. Okay? So the VIX is listening. The VIX came up, tapped into that zone, coming down right now. If the DXY created that shock here, we tap into that order block to fill up that inefficiency right now. Is the question will be, can we come back down further here? Temporarily, right? Temporarily. Overall, we still have a major reaction here. Okay? We still have this zone right there. We still have this area right here. We still have the swing low to swing high here. We still have the 50, which is a very, very important level. Right there, you will see. 110.5. Okay? I do not think that we can potentially come back lower. If we do come back lower, then we potentially come back lower here. And then potentially tap into that area here. And then just retrace back further up to continue the way to the upside. That's what I personally believe here. In the next coming days or weeks ahead of us right there. Okay? However, for now, we are still waiting for the meeting. Let's see if everything is aligning here.
To bring inflation down to 2%.
There we go.
And we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. To achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. Forecasts. So on the first,
here we go.
Forecasts and those of most outside forecasters do show growth running on potential.
Oh.
On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation.
Yeah, we're going to take out these highs here.
Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what?
The funny thing is, trust me, this is all scripted. They know exactly what he's going to ask. He's already looking at the answer before you ask that question right there.
Has happened to the economy, and give time to catch up in the real economy. The rate increase time to catch up in the real economy. Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time.
Okay.
And I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we're just.
Look at that, guys. Look at that, guys. Order block there as well.
Of what might be restrictive.
Okay.
And certainly, in my view and in the view of the committee, there's.
Wow. High is taken out here.
Hi, Chair Powell, Rachel.
Liquidity hunt was real, guys. What a massive manipulation here.
Projections show the unemployment rate rising to 4.4% next year.
Wow.
And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So
the XY coming down confirmed here.
In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks.
This is big,
Beginning
like we
with the
said.
pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation.
There we go.
So these are the kinds of events that are not really seen.
Wow,
in
wow, wow,
prior
wow,
business
wow, wow,
cycles.
wow.
And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions.
Looking forward to discuss everything with you guys here.
Those developments, if sustained, could help ease the pressures that restoring price stability while achieving a relatively modest decline.
I have to say there are opportunities there. Okay.
Soft landing would be very challenging, and we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the...
Just to clarify, I'm personally not going to trade until the press conference is over whatsoever and the volatility has decreased here a little bit, okay?
Your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about...
we will look at all the opportunities here, though.
As the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean...
Okay, the XY is dropping, yes.
Meaningfully, putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about
okay, this one is not going to happen here.
Some sort of
this order block right here, guys.
Inflation expectations. I think you would see at that.
Why? The XY is right here.
Positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for
buyers coming into play here. Buyers coming into play.
On the steps, you say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, you know, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, you know, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation has...
Look at this, guys.
Our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but inflation has not really come down. If you look at core PCE inflation, which is, you know, a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is
this order block right here, 70.579.
We can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, you know, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to, you can't really, you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that.
Look at that, guys.
One thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Same as gold.
Hi, Victoria Guido.
Gold held here.
I wanted to ask about the balance sheet. You all have left
Wow.
that you might sell mortgage-backed securities, but we've
Gold held this order block here.
Slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said.
Oh, guys,
that
we're gonna have some fun. We're gonna have some fun after this.
Once balance sheet runoff is well underway, I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world.
What is the VIX
We're
doing?
in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives in our case.
Okay, this is good.
Price stability, but we regularly discuss what we're seeing in terms of our own economy and international spillovers, and it's a very ongoing, constant kind of a process. So
okay.
We are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together,
Wow.
our staff puts together, and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and rates and things like that at various times. But really we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in
Peter, we're going to have a beautiful conversation, my friend.
March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to
look
think
at that. Okay,
this will continue to be a reasonably strong economy. Now the data sort of are showing that
we can still come down, guys.
Is going to be below trend this year. We think of trend as being about 1.8% or in that range.
Look at that.
We're forecasting growth well below that, and most
break of structure. Boom.
You're right. There is
higher high.
There's certainly a possibility.
Order block continuation.
Stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking, and the lags...
Keep a close eye on this pink line here, purple line here, 110,474.
How will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below-trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower, that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation.
Okay, gold's going to break down a little bit temporarily now.
Really light the way to another period of a very strong labor market. We have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people.
We're going to talk about this.
Wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, And that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that.
John says, "Did you cancel the gold sell?" No. We were not supposed to sell gold here.
Unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control, and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions,
it pisses me off, man.
Then sort of job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots, and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
No, I think that shelter inflation is going to remain high for some time. You know, we're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think you know, hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be
there we go.
next year? How restrictive?
So I think if you look, you know, when we get to, let's assume we do get to that level, which I think is likely, you know, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, you know, that could be, you pick your measure. It could be, you know, there are all kinds of different things you could pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, you know, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right. There we go, guys. There we go. This was Uncle Jerome. To be honest, the actual conversation itself was not really that special right there. Was not really that special. It was nothing interesting that came out of there. You could see it also in the price here. Not something that we were really looking for. Okay. So what's the deal with inflation here? All right. Who is benefiting from inflation right there? Let's talk about inflation real quick. The thing is about inflation is very interesting, right? So the higher the inflation, the more it benefits the people with large debts. Okay? Who are the people with large debts? Most of the time the rich people, because they have used debts to buy assets, to leverage the assets and to create cash flow, right? So when the interest rate's going up, when inflation is going up, when the prices are going up, people are paying more and more for these assets, right? So they make more money. So this is the thing. It's a fishing rod right there, waiting for the bait, right? Low interest rates, right? And it's not for the people that turned assets, you know, to use debt and turn it into assets. It's for the people that used debts and turned it into liabilities, right? Such as mortgages, right? That's why we call it a mortgage as well. So this is very interesting right now. Right now we are in that moment where we're gonna roll the rod, the fishing rod, and we're gonna see what we have caught in the last couple of years right now. This is the moment, right? Can you blame the system? Can you cry right now and say, yeah, it's also unfair? No, because the opportunities are equal to everyone. Everyone has these opportunities right there, right? However, it's still sad. It's still sad that a lot of people, you know, have to suffer here, and it's definitely a rich game. It's just a rich game that we're playing right now. Right now, we're in the phase where I mean the 90% here, the small retail, the people with families, you know, a hard earning or hard working, you know, fair job, right? Trying to take care of the families, etc. These are the people that are gonna pay for the debt of the people with large sums of debt right there. Okay? That's nothing we could do about it. This is just how it is. This is part of life. So how can we react? What can we do about it? Well, like I said and preach all the time, we need to find ways of, you know, getting external sums of cash flow. All right? This is what we're doing. This is why we're trying to build this community. This is why we are learning a skill that can provide cash flow on the side, right? If you have your job, it can help as an alternative to make some extra money, to put some extra, you know, dollars in your pocket to help benefit the support of your family, the people around you, or yourself, the people who need. Maybe you need it yourself, right? Maybe the job that you're doing is not enough. That's why a skill is a must-have right now. And the beauty about trading is we're learning more and more and more every single day about the financial market. We're trying to take things to the next level. We're trying to take this, absorb all of that information, and we're getting smarter every single day. It's not just only the trading. Because of trading, you learned about the VIX. You learned about the dollar index. Trust me, you already know more than 90% of all the people right now that do not know anything about trading. Trust me. The dollar index, you know, the VIX, all the indices, all the correlations, you know already way more than the rest. So leverage that. Leverage that right now. Try to make it happen. Try to take things to the next level. Don't give up, Peter. Really make sure that you're practicing. Keep going. It took me 3 to 5 years, right? And we're still in process. We are still in a process right now. All right? So it never stopped. The hustle never stops. This is the way out for us. Finding it still. But the good thing is, there is so much money in the world right now that we can just put a little bit of our buckets underneath, you know, the money trees and just be very, very patient, right? We just be patient. We patiently wait with our building while we're building our skills, while we're leveraging our, you know, analysis, and we are snipers. We're going to take that, put these little buckets underneath, grab a little bit from here, grab a little bit from there, right? Get funded, boom, get a whatever, a prop firm account, whatever it is you want, right? So much money in the world, guys. Take advantage of that. All right. So let's get back into the charts right now. The meeting is over, so I'm very, very excited. Looking forward to what we actually can discuss right now. Okay. So things are looking very, very good, though. I have to admit, things are looking very, very nice. So what do we see here? All right. Let's start with what we talked first about. We talked about the indices. Okay. This is definitely getting rejected here. Okay. Clearly, this is definitely the order block that we rejected. So the question is, are we coming back down with the VIX right here? That could be good for the US 100, for the indices right there in general. Okay. The other thing. What did we see here? So we have the 1 hourly. Liquidity is built up above these ranges right here. Okay. Like we already said. So the question is right now, what are we gonna do? We have taken out this liquidity underneath that zone. This is done. This is taken out here in an aggressive manner, okay? I personally expect it to go back up like we are, you know, trying to go up right now. However, of course, when you see an FOMC meeting or massive manipulation, what most of the time happens is they abruptly go price back down to the immediately reverse price back to that direction they want to take price towards to, okay? Does it mean we're gonna go up right now? Well, let's have a look. Let's have a look right here. So what are we seeing here is very, very clear. This one is invalidated. We have this order block right here in the 3 minute. This is a nice order block where we can look for. Okay. The 70.5 and the 79. Why do I like it so much? Well, clearly we have taken out all the liquidity underneath here. We have the change of character right there. We have the change of character right there. Okay. We broke structure to the upside, changed character to the downside. Boom, reverse price back up, changed character to the upside. Now we're mitigating, swing low to swing high, premium area of demand here. Initial reaction was good from this order block right there. Was a good scalp, but it was not, of course, a trade we're looking for. So what are we seeing here? This next order block right now at the 70.5 and the 79. That's the order block, you know, we should potentially look for. Okay, does that align here with the VIX? I think so. The VIX has more downside potential right now. This reaction is very, very good. I like what I've seen here. Especially the fact that we have created another lower low here and a higher high there. Okay, very good reaction so far from the VIX right here. Also, taking in consideration, of course, we will go to gold, right? But first, let's go to the DXY here. This order block right now. This was the order block here. We came back up, came back down, tapped into that area. Now we're getting rejected from this order block right there, right? We're getting rejected from this order block right there. It's very, very choppy here. Okay? It's very, very choppy here. We have not created a... Okay, we just have created a lower low here. Okay? So we're going to see what the reaction is will be here. However, there is still a chance we break it. That we fill up that imbalance. And that we tap into that zone right here. If that happens, then of course we can look at the gold, at the US 100. These are the opportunities right now. But let's zoom out a little bit more. Let's zoom out a little bit more. Okay, because it's nice here. It seems quite clear what the direction is right now. However, also the reaction here is very good. One more time. However, let's take the solar lap here and look at all the levels right now. Okay? So we took out the previous daily low. Immediately took out the previous daily high. In a matter of what? 20 minutes? 10 minutes? Pretty much like that. So we took out the lows, took out the highs. Very, very crazy news right there. Okay, liquidity here is taken. We even took out the previous weekly lows here as well. So now we have taken out the previous weekly low, previous daily low. And we immediately reverse price back up here. We have different zones right here. Okay, we have different zones that potentially can align now with the indicator that we're looking for. The only thing that we have not taken out is the previous weekly high. Okay, the previous weekly high is, I believe, a little bit higher here. Right there. Okay. So liquidity is taken, guys. Look at that. So what's the next step here? Well, that's simple. Then what I personally do is just look at the DXY to see if the correlation is there. And look at market structure. What is the market structure telling us right now? Okay. Well, we broke these lows. We broke these highs. And we're continuing way to the upside here. We took out the liquidity straight away. Would I long from here? Not really. Not really. I would wait to come into a premium area of demand. To then look for a potential confirmation trade right here. Right? I would go half risk. I would potentially look for a confirmation trade right there. That means that if the dollar index comes and taps in that range right here. Let's clean it up one more time. Okay? To the upside. To the downside. Right there. Came back up, came back down, came back up, came back down. Came back up. That's why we're seeing that reaction here right now. Okay. Tapped into the 70.5. Exactly. We tapped into the 70.5 and now we're holding right here. However, on the other hand, we have created a lower low here. We have created a lower low again. We have that order block here. So that's the potential step right now. If we break it, what's the next layer? Okay? The next layer is this one right here. If we break this one, this is invalidated. And therefore we can then continue the way up here. Peter says something very good. He says, I can only advise anyone to trading to be patient. Do not trade every day. Never chase the market. Let the market come to you. Well said, my man. So this is what we're looking for. If we tend to break this level right now, and we come back up here. Then we're gonna fill up that inefficiency and then we're coming back up. Then gold is of course coming back down towards this area. It will break this level here and tap into the following ranges right now. Okay? Gold really made an explosive move right here. Okay? Took it out right there. Now we're gonna settle down. So even I do expect potentially for a short period of time, let's say we come back to this range and we would hold here. Okay? I think personally that we're first gonna consolidate for a while before making a move. So what you also can do here is to come back down, see if we tap into that range, if this level is actually respected here, then wait for a higher high, then wait for the confirmation, wait until we're done with consolidating here potentially, wait for the reaction and then potentially look for an opportunity right there. Okay? I think that makes way more sense right now than actually start looking for a direct trade at this particular moment. However, the direction in terms of market structure here is relatively clear. So that's good to know. That's beautiful to know here. Very, very nice. Okay, the DXY is coming up. That means we're gonna break the zone very soon. In the meantime, it has a massive effect on the US 100. You can see it. The correlation is very strong here. Let's have a look at the VIX here as well. It's coming back up at the same time as well. So the VIX is gonna now show us the exact reaction. Okay? That means that we're looking for this reaction right here. Then this reaction right here. So now this one is validated. One of these blocks here is potentially validated right now. So now the question is, okay, are we gonna hold here, yes or no? Right in this area. So my question is, be a little bit patient here, guys. Wait for the reaction here. And especially gold is looking very decent. But even if you tap into the zone, personally, I would wait for another confirmation. Another break here. So let's say we come back down, we tap into the zone. The zone is respected. We start consolidating here. And then we make a move to the upside. Then wait for that move. And then potentially, you know, come back down. That's the exact move you want to see here. Because in the end, the dollar is looking to go up. Alright? The dollar is looking to go up in the midterm here. Are we looking at any short possibilities? No, that not. We don't see any short opportunities here right now. So they definitely take that in consideration. And therefore we have to break a decent low here. Gisa says, Lorenzo, I'm scalping a cash account, had some losses during the news, but made it all back scalping. Great, my brother. Well done, my man. Wow, 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 look at the indices right there. Okay, the VIX is gonna... The question is, are we gonna hold it for the VIX? That's the true question right now. Gold is holding very well. I have to say in this order block, gold is holding very, very well. Okay, we're invalidated right now. We have created a higher high here. So this zone is respected here. Down, up, rejection here on the 70.5. Creating a higher high here. Question is, are we gonna reverse towards this zone to fill up that inefficiency right there? And are we gonna get rejected there? If that's the case, this thing is still valid. This setup here is still valid. If we break at it, this is invalidated right here. And everything that we're looking for is in essence already invalidated for gold. All right. The euro is entering a key level of support here. I think it's a daily level. Yeah, it's a daily level here. So that's an interesting zone to take consideration as well. The fact that the euro right now is holding this this level here. Why? Because we saw that same reaction here to the downside, to the upside. We came back up, consolidated, came back down, retraced already from this range right here, and then took off right there, created a new high. Created a new high. If you go to the 4 hourly, you see what I mean here. We came down. We came back down. We came back up. Created a high. Came back down, tap into that range right now. So this one is definitely, this will be a strong range of support here. Okay. So, okay. The fact that this is going up right now, I think gold is gonna come back to that range. What has Bitcoin been doing? Wow, look at that for Bitcoin as well. Of course, very, very similar right now. There we go. What a reaction, guys. It's worth it to stay up here, right? It's 3:30 here. In the night, in the morning. But this is what you can expect. This is what you can see here. Absolutely fantastic. The reaction so far. So from tomorrow, we're gonna see right now, from a technical standpoint, this is the level where it's all about here. Okay, this zone right here is the level where it's all about. We're entering that zone right now. Okay? If we break this level, we're pretty much can start looking for bullish segments for the continuation there. Pretty much look for all the US dollar pairs and so on. All these layers right there. And start looking at particular, you know, longs right there. This is the zone right now. This is the order block we need to take consideration here. Okay? So I want to be waiting. I want to know exactly what will happen here right now. What the bias will be. The overall bias of this area right here. Are we going to break this order block, or are we going to stay underneath and come back down, create a lower low? If you create a lower low, boom. Then it's clear. Then it's clear what we can do for tomorrow. Okay? I want to wait for that confirmation there. That's it. Why says, do you like Bitcoin? Yes, I do like Bitcoin. I do like Bitcoin. Okay, so how do we analyze a chart, especially for tomorrow here? Okay. Guys, send me some pairs right now, and we'll discuss all of them. We're gonna do a deep analysis here. We're gonna do a deeper analysis right now, and then let's see from there. What's up, my man Paul? How are you, brother? Fantastic to have you here, my friend. Okay. Samuel says GJ. Wow, okay. Okay, first we're doing the top-down analysis right now. After that, we're gonna look at the correlations, okay? Let's invert the scale here. It's simple. What do you see here? This is on the daily. We're definitely in a downtrend here. Okay? This is an inverted scale. Look out these highs here. Swing high to swing low. We are overall in a bearish bias here for the Japanese yen. All right. So the continuation for the Japanese yen is likely. We can tap into one of these areas right here to the, let's say the 50. The 50 is the main area we can look for. Okay. And then after that we go to the British pound, then we go to GJ. So this is the range right here we can look out for. This is the main key area. This is the equilibrium of this swing high to swing low. Why? Because we broke structure to the upside here, to then break structure to the downside. Right, we're retracing back up. We're looking for the continuation. The overall bias is very bearish. And we're simply looking for the continuation here. That's it. Okay? The only way where we can completely reverse here, if you take out these lows here, if you take out the swing high, that would reverse the trend. So far, we have a long way to go to reverse the trend. So until that moment, we are still proven to be bearish for the Japanese yen. Okay? The British pound is a little bit different. Why? Because we have not created a higher high to then create a lower low. So there is a chance that we potentially can look for a potential reversal anytime soon here. So that's interesting. So let's take that knowledge in consideration right now. Let's go to the higher time frame here. Okay? Of course, Japanese yen was bearish for a significant amount of time right now. So what are we looking for? We're looking for a bullish reaction, right? Okay, how do we do that? Well, it's very simple. Again, break of structure to the downside, change of character to the upside on the daily, okay? Higher time frame bias here. Swing high to swing low. Do we see an order block in a particular... Sorry, swing low to swing high. Do we see an order block in a particular range here? We have one at the 88.6. Yes, that's one. Okay, let's write this one down here. Let's mark this one. We have one in the 70... No, not one in the 70.5. No, we have one in the 62, right? Okay. And we have one right there a little bit higher, but that's above the equilibrium. So this is not what we're looking for. We're looking underneath the equilibrium for the opportunity here. All right. What's happening here? There we go. Break of structure to the downside, change of character to the upside, swing low to swing high. Right there. 62%. That's the Fibonacci. Why? Because we had an order block here. We had a rally, a base, a rally. We had a bullish, a bearish, a bullish order block. Right? Bearish order block right there in the middle. We tapped into that zone right there. Beautifully took out from there. This is a daily level. Okay? Very important to mark out the daily level right there. What happened after that? Same thing. This is on the 4 hourly. Let's go to the 4 hourly right now. All right. Right now we're going to do top-down analysis, guys. I'm going to go deeper for you guys purposefully to to really step by step see or explain how we do the top-down analysis here. Okay? Change of character to the downside. Sorry, break structure to the downside. Change of character to the upside. Right there. On the lower time frame. You see that? And what happened? Swing low to swing high. It's the same process. That's interesting. Let's go to the lower time frame. What do we see here? Hey, that's interesting. Again, swing low to swing high. 17.5. 62 again. Okay, do we see an order block? Yes, what do we see this time? There we go. That's the reaction we had here. Okay? We saw that reaction right now. Long there. Boom there. Go up higher to take out these highs there. Okay? That's what we're looking for. So we're coming back up. We're coming back up right now. So let's go to the end here. Where are we at? Okay. There we go. Okay, let's go to the 4 hourly. It's the same thing. We saw it here as well, right? Same thing. And we're gonna get to the recent area here, okay? Break of stocks to the downside, change of character to the upside. You see that? We're following the trend here. We broke the trend to the higher time frame. Do we see an order block? Go to the lower time frame. Yes. What did we see? Bullish, bearish, bullish. Beautiful indecisive candle in the middle. Let's zoom out. What do we see here? Hey, tapping into that zone. Beautiful reaction. Twice. And we took off from there. Okay? However, what do we see right now? Same thing. It's the same process. Same thing. Right here. Right there. Yes, we have expanded in a crazy way. I understand that. However, the essence is still the same here. Okay? We are still in a zone. We have actually entered a premium area of demand here. We're entering premium areas of demand here. Okay? So if you go to the lower time frame right now, let's have a look here. There we go. This was the moment here. 79, 70.5, 2-hour order block right in the center there. This order block is very interesting. Okay? So does that align here with the index? This is what we're looking for. Now we have determined our higher time frame bias. Now we are looking for a potential, long. Why are we looking for a long? Well, we have just looked exactly at the Japanese yen basket, right? Okay. So the Japanese yen basket showed us this. We created a change of character to the upside, change of character to the downside. We came back down. This is the swing high to swing low. This is the equilibrium. This is where you're going to see the first reaction, where the first major area of resistance should potentially come into play. If we can take that in consideration right now, we have that range right there, and we see it aligning. And we look at GJ. Do you see the difference? You see the alignment? If we tap into that zone here, and we're getting rejected here on the lower time frame, we can look for confirmation entries, right? We're looking for a lower time frame confirmation entry, taking out these lows, boom, coming back down. If we tap into that area and we're seeing a rejection, we're creating a lower low on the lower time frame, Then GJ from 161.7. That's the potential range where we can start looking for a potential long as well. Also, same potential opportunity. Looking at the downswing right there. Coming back up, tapping into that range. Creating a higher high. Potentially creating a bearish reaction. Coming back up. Coming back down. Tapping into that zone. And continue the way up here. Okay? That's potentially the range here. So do wait for a confirmation there. Look for that area. But it aligns beautifully with the basket here. From a higher to a lower time frame right there. So very, very nice. Looking very, very good. We also have this zone right here. Okay. This breaker block right there. However, I do think that there is still some more upside potential right now for the Japanese yen. And that we therefore can come back down potentially towards that potential range right here. Okay. In my opinion, it would make a lot of sense here. So if we come back out and we do swing low to swing high, then this is the range where we're looking for at the 79% FIB. Okay. That's the analysis for GJ right now. So let's do a few more for you guys. Which one is next? Which one is next? Samuel, my man, thank you for all the support, the input in the community as well, my man. I appreciate you, bro. But what do you think when the British pound news comes out? I don't really care. I do not really care. That's why we wait for the confirmation. We're looking for that reaction here. Tapping into that order block. Looking at this zone. We know what the overall higher time frame bias is on both the Japanese yen and on the British pound here. Okay? On the flip note as well, if you take the interest rate differentials, we have a positive correlation here. Okay? The interest rate of the Japanese yen is minus, I think, 0.1. So we're still looking potentially to take price higher in general. And this is exactly what we're seeing on the higher time frame bias. It confirms the bias here. So the fact that we're retracing back down is the beautiful, beautiful moment here to look for potential opportunities here. Okay? Gold is at an OB. Okay, let's have a look at that one. Wow, look at the NASDAQ here. Wow, wow, wow. Okay. Very, very interesting. That means that the VIX right here. Wow, okay, the VIX is breaking. Alright. The VIX is breaking. Like we said, if this is getting broken, extremely bullish. Continuation, very bad for the indices right there. Makes sense with the news release right there. Okay. Let's have a look at gold. Okay, gold is, yeah, not there yet. However, it tends to come to this range right there. Let's have a look at the DXY. And then we go to the next pair. Okay. If this gets broken, gold is invalidated. Billy Joe's British pound, Australian dollar is interesting. Okay, let's take that one in consideration. Somebody says USD cut, UG. Okay, UJ. EU. Okay. Okay, let's go to the daily here. Okay, this is very interesting. So what we're doing here, we're actually building a lot of liquidity above these ranges here. A lot of liquidity above these ranges here. So that's quite interesting right there. We have this zone right there. But we need to go to the lower time frame to determine what we're looking for right now. Yeah, there we go. So what you're always looking for is a break of structure to the downside, or other way around here. Coming down aggressively. To then potentially change the direction to the upside, right? To then change the dynamic again. This confirms exactly what we're looking for. Okay? So we came back down, came back up, then dropped further up. So the only thing that we're looking for right now is the retracement here. We're looking for the retracement right now. We have taken out the liquidity that was built up above this area, so maybe this was the retracement. Okay? We're gonna look at the interest rates, we're gonna look at the indices later. So let's draw this swing high to swing low here. And what do we see? The 62 was the rejection. Okay, so we already came into a premium area of supply and we got the rejection right there. So the only thing that we're looking for right now is to go to the lower time frame and to see what happened after that moment here. So what do we see here on the lower time frame? We broke structure. Broke structure to the upside. And what do we see? I think it's a 2-hour block. 2-hour order block. These are the opportunities we're always looking for, guys. It's key that we're seeing something happening like a break of structure to the upside, change of character to the downside, or a break of structure to the downside, change of character to the upside, right? And if it aligns from the higher to lower time frame, we start on the higher time frame bias, we're zooming out there, okay? This is what we're looking for. So what do we see here? Area of demand. What happened there? Boom, look at that, guys. Look how clean. If you can fish this, right? From a higher time frame bias. We came back into that range. We know that we can start looking for the retracement to a premium area of supply here. Right, that's why I marked this one out. We saw this one. We did not sell the full retracement towards a premium area of supply, the 50. Most of the time you retrace to the 50, right? That's where shorters come into play again. Because then it gets interesting, then it gets rewarding for them. That's why there is a chance that we come back up here. So what happened? Change character to the downside on the lower time frame. Change character to the upside right here. What happened then? What kind of order block do we see? We're seeing a 3-pattern candle. We're seeing a drop, a base, a rally. After that, what did we see here? Straight away the reaction. Would have you traded this one? I personally not. I'll wait for the reaction here. And what happened? Boom. Now we tapped into the 62. Now we know that there is a reaction here. Right? These are the trades we're looking for. These are the trades that we're looking for alive. While we're scalping. This is a 11 to 1. Right here. Okay? Liquidity was built up there. Took out the liquidity. Tapped into the 62 FIB. That aligned with this higher time frame break and change of character. Then we came back down here. Okay? And that was a beautiful, beautiful trade opportunity. What happened after that? Let's go to the lower time frame. Same thing. We continued the journey here. We created. A shock to the downside. Shock to the upside. Tapped into that range. Came back into that area. Came back here. And we took off from there. Okay, I think it was that gap. We filled up that gap. We had that order block sitting there. We tapped into that range and again, same thing. This one is invalidated. We came back up here, but what did we do right now? It's the same concept. Okay? We still created a massive higher high here. We have now validated this swing low to swing high to swing low here. This was the swing low. This is the swing high. This is the ranges we're looking for. That was this order block right here. Let's go to the 30 minute. I think it's somewhere around that area. Right there. We tapped into that range right now. We go in. We look at the lower time frame. What do we see there? 5 minute. Okay, we tapped to that zone. Alright. Great. It's very simple. We are now waiting on the lower time frame to break these highs here. This high wants to get broken here. If we break this high, we can draw the Fibonacci on the lower time frame right now, from swing low to swing high, towards that A range where we're ending up with. Could be this one, could be that one, and then potentially the order block we can start looking for is this one. A bullish, bearish, bullish order block right there. Within the 17.5 and the 79 FIB. If we take out these highs here, okay? Actually, it's this one. If we take out this level here, the body, and we come back up here, then this is the potential moment where we can look for an opportunity. Tapping into this FIB, taking out, what are we targeting? Keep in mind, all the liquidity is built up above this range here. Okay? Let's go to the 15 minute. Let's put on the indicator. Let's give us some more information. Previous daily low, previous weekly low are taken. Confluence. Extra confluence here. Okay? We're going for the previous daily high. That's the level. Right there. Okay? So if that happens and we create a higher high here, then this is the entry. 70.579. We're targeting potentially the previous daily high. Will make a lot of sense. We have taken out the previous weekly low, the previous daily low. And we have taken out then all of that liquidity as well. There you go, my man. Hope that answers your question. Very interesting, by the way. Kitchos is GU. Paulo says, hey Lorenzo, how are you? How do you set up your take profits? Twin trade, single TP. I personally take one trade. And a single TP, but I higher my take profit. I higher my stop loss. Every single time. If we create, what do we see? If we look on the higher time frame here and we look at these levels. And we have this change of character, and we come back down and we take off from there. And my entry was here, from this one. Then I higher my stop loss towards here, right? And then towards here. And then based on that, my stop loss constantly goes higher and higher or lower and lower. Okay, let's have a look at oil. I'm gonna do a few more for you guys. Then we're gonna do the breakdown for tomorrow. And then I'm gonna go to bed. It's 4 o'clock. By the way, I love all of you guys. I'm very, very happy to have you guys on our side here. To analyze together. To learn the metrics, everything that we need to know. You will see, over the long term, we will make money. The people that think that I'm, you know, whatever... Of course, whenever you are having a responsibility here, and people are, you know, seeing you 1 or 2 times, and you're not making money, hey, that's fine. I'm here for the guys that are willing to learn, that understanding how we take the long-term approach, how we analyze from a higher time frame bias. That takes time towards the lower time frame right there, right? This is what we're looking for. These kind of people I would like to hang out with, surround myself with, okay? And these are the people that I would like to help here, that I would like to learn from myself, based on their feedback, and to improve all together. Okay? So for the British pound and Australian dollar, that's pretty much that. For GJ, that was also very nice. You guys know what's up for GJ here. Okay? We came down from the weekly here. Sorry, from the daily. Pretty clear range right now. Let's go to oil indeed. Okay, it's super clear. I'm gonna take you guys right now, and it's no joke, to the monthly. Same thing. What do we see happening? We started to build up. We took out the liquidity that was built up here. We massively expanded right there. We saw a huge climax right there from this range here, right? Massive reaction. What happened from this range? Again. Break of stocks to the downside. Change the character to the upside. This is the swing low to swing high on the higher time frame here. Okay? The 50 is validated. Look at that. Let's zoom in a little bit. Let's go to the weekly. We're gonna go to the daily, 4 hourly, and so on. We're gonna zoom in here. Do we see something interesting on the weekly here? Sometimes I like to invert the skill. No. Nothing spectacular. Okay, let's go to the daily. We're coming close, by the way. I need to see exactly where this area is here. Takes us from this last high to this last low. There we go. So the major order block we're looking for here. This is a major weekly level. This is the level we're looking for. This is the 50. This is the equilibrium from the monthly, guys. From the monthly. From the weekly. Or weekly here. Change character to the upside. We came back up here. Swing low to swing high. This is the order block we're looking for. This is the 50 order block right there. Beautiful reaction from this range. Potentially. This is where the equilibrium is built. We are getting close. We are nearing that particular zone right now. Okay? However, how much do we have to go here? 12% to go. Significant still. Okay? So therefore, let's zoom in here. Let's go to the lower time frame right now and look for, you know, potential reactions right here. Okay? So it's simple. The overall time frame shows that we can potentially come back down more. Alright? We still can go to the premium areas of demand here. On the higher time frame, on the weekly. If you then go to the 4 hourly, then we're seeing the same thing happening. Broke structure to the upside. Then broke down here. Right? Completely. Let me validate this for you guys. There we go. All right. There we go. So the overall bias is still bearish here. On the short term, on the lower time frame. We tapped to came back up here. We continue to wait down. Let's go to the 1 hourly. This is the range. Sometimes for me it's easier when I just invert the scale. It can be a tip for you guys as well. For me it's sometimes easier when I invert the scale. I see it faster. It's my, I don't know. Sometimes it helps. It works for me. You could try it out. But don't get confused and don't forget to put it back. Alright? Don't forget to put it back. Very, very important. We took out the liquidity here. Right now. Let's go to the time here. We see, what do we see on the lower time frame again? 30 minute. Okay. Interesting. We broke structure. No structure to the upside here. Continuation down. So the continuation is still down here. Again. We came back up here. But we immediately invalidated that zone here. Okay, came back up, came back down. Swing high, swing low. Let's see on the 15 minute. Yeah. Rally based drop. So we're still looking for shorts here for the US oil. I would not look for potential longs here right now. Why? Yes, we have this area here. Yes, we're bouncing from this zone. But I do think that this range here, that we broke, it came back up, we came back down, we invalidated that zone here. Come back down, and the overall higher time frame bias tells us that we still have not reached a premium area of demand on the higher time frame. So we can still come back down a little bit here. Okay, and we ended up at the 15 minute right there. So we have that range. Potentially creep up here. Tap to that range and continue the way to the downside. Trey Hawkins says, thank Lorenzo. Enjoyed it. Peace out. Appreciate you, man. Thank you. It's very, very late. No problem. Danisha as well. Appreciate you. Every single day. Okay, we're gonna do one more. One more. And then let's have a look there. Euro GBP. Okay? And then we're gonna look at the setups for tomorrow. Because there are some interesting things going on here. Okay. I like to zoom out as much as I can to get a good understanding of what's happening here. Okay? I like to look at as much as I want here to just understand exactly if it aligns here from the higher time frame. This is what's crucial when we're looking at these higher probability setups here. That we are aligned completely with the higher time frame. Okay? From this moment we can zoom in, we can start looking at all the opportunities right there. And then potentially start looking. So what do we see here? Sorry, we saw the break of structure to the downside. Every single time you see me doing the same thing. Break of structure to the downside. Change character to the upside. We came back up here. Okay. This is a very significant chart here. This is the weekly. Can also work for the weekly right here. Okay, take that in consideration. But we will get there, we will get there. We will use the interest rate differentials. We're gonna go through everything here. So we have that zone. And what do we see here? Swing low to swing high. Validated. That's interesting. What do we see? We tapped into the equilibrium here. We tapped into the equilibrium and we saw that bounce there. Okay? We saw that bounce from this specific zone here. That's interesting. Right? That's why we use the Fibonacci. First market structure, then the Fibonacci. Because then we know exactly which swing high to swing low or swing low to swing high we're gonna take. Danisha, thank you so much. Have a wonderful, wonderful day. Appreciate you. Thank you. So then the next step. What do we see here? We see that the 50, the equilibrium right here, is a beautiful reaction. We still have a major zone. Major zone. I still like to highlight these zones here. Okay? But let's go to the daily. We tapped into this order block here. And we immediately saw that reaction to the upside. That's interesting. Alright? Let's go to the daily. Do we see an order block that aligns there? Let's have a look here. Yes. Yeah, exactly. Okay. Right there. We mitigated to the zone. So now I think, okay, beautiful. All right. We have seen that reaction here. We came back into that zone. And what happened on the daily right now? Something very nice. Seeing the same structure here. Okay. So the last time we tapped into that zone, what did we see here? We created again. Break of structure to the downside. Again. We tapped into that zone. He came back up here. Created a higher high. Right there. Let's go to the lower time frame now. Now we can go to the hourlies here. Okay. So let's go to the yeah, 8 hours fine. 8 hours fine here. Again, we saw break structure to the downside, change the character to the upside, right? Right here. We broke this, we broke this. We tapped into that zone from the daily. Mitigate price further up. What was the following retracement? Right here. 8 hour order block. Tapped into that order block beautifully. Created a higher high here. There we go. So what happened here? Same thing on the lower time frame. Let's go to the 4 hourly. Came back down. We keep doing it, guys. Right? Came back up. There we go. Swing low to swing high. Confirmed, right? What are we looking for? This zone. Why? Because this is the moment where we changed our trend. What happened here? Okay, initially we tapped into that order block. Mitigated to 62. Tapped into that area. And came back up again. Came back down, we actually came lower in the 79 range. Alright, that was initially the range right there. Eventually tapped into this order block here. Came back into that range, tapped into that zone, took off from there. But now it's gonna be important, okay? Now we know exactly what to do. We know that the exact bias is extremely bullish. So let's remove everything. We know bullish bias, okay? Very clean, very nice. What do we see here? Can even use the daily for that if you want to keep it clean. You guys know it. Change character to the break structure to the downside. Then where did we broke it? Eventually. Right there. This is where we broke the high here. So this is the last low. The moment we took our break of structure, we know, okay, what is a swing low? That's a swing low here. This is where we at right now. Okay? So this is our overall bias right now. And if we want a long and we're looking for long-term setups on the higher time frame, then these are the ranges we look for. However, on the lower time frame right now, what are the ranges we're looking for here? We're not gonna come like this, of course, right? So we can still look for long opportunities right now, because we are aligned with the higher time frame bias. Everything is good, everything is clean. We can still long, right? We just need to see and look for the same opportunities here, right? Such as, but keep in mind that we have just this higher time frame bias, that we can start looking for the higher time frame setups here. Okay, we can still look for the long time frame bias, but the moment we can look for short opportunities is when we're seeing something happening, and it will show you in a second right here. Until that moment, we can start still looking for the same thing. It's repeating itself. Break of structure to the downside, change character to the upside. What do we see beautifully, guys? Swing low to swing high. Right? To the top. What's that? Do we see that candle? Yes, right here. Bullish, bearish, bullish. Rally, base, rally. Tapping into that zone. 62%. What happened? This was a monster trade. These are the trades we're looking for. Look at that. 10 to 1. Weekly, no, monthly, weekly, daily, 8 hour, 4 hour. Here we are. Okay, so what's next? What's next right here? Okay. Same thing, guys. Same thing. Okay. Let's go to the 2 hour. Change character to the downside. Sorry, break structure to the downside. Change of character to the upside. Hey, same thing. What is confirmed? Swing low to swing high. Do we see areas in the premium area of the month here? We can long from? Yes, 1 hourly. What is it? Actually, 2 zones. The 62 and the 17.5 here. Okay? This is the amount we're looking for. We're looking to long here. We're looking to long from this range. Does it align here on the lower time frame? Yes. Why? Liquidity, man. All the liquidity is built above that area here. Enough reason for it to be taken out there. Okay? So right now we look at the 1 hourly. We're seeing that reaction here. We have that order block beautifully. This is what we're looking for. We have that 1 hour order block right here. We even have one at the equilibrium right now. This is where we're reacting from right now. Okay? So this is also fine. However, what do we see? We go to 30 minute. No higher high yet. Okay? So if we come back down right now, the wick I don't count here. If we come back down right now, that's why we're using lines. If we come back down right now and we tap into that range, wait for the confirmation here. If we break here and we come back down towards this area, this is a very, very nice one. Right there, this order block right here. Okay. Wait for the reaction and wait until you break a clear higher high. A lower low, higher high. That's what we're looking for. Lower low, higher high. The moment you see that, that's the moment we can start looking. Okay? We have created a lower low. We have not created a higher high. So the question is, are we going to create a higher high right now? Or are we going to create a lower low again? That's what we need to know. If you do not create a higher high, we do not go long. We don't look for confirmation. If you do create a higher high, it's very simple. We're looking to go up. We're going back down. We're tapping into that range. We're going to take off from there. Again, the moment we come up, the only thing that we're doing here on the 50-minute, again, same thing. Swing low to swing high to wherever we end up here. Okay? We're looking for an order block on the 10-minute, 5-minute, and so on. That's what we're looking for. Waiting for the expansion. Only using the equilibrium to long from. Okay? Not higher. 50% of or lower. This is what we're looking for. So we're looking for a long opportunity and it's coming very, very soon into play. Liquidity is getting built in the upside here. And I do like what I see here. However, the question is, are we really going to break the highs here? That's the question right now. Because if not, we can start looking at lower prices, look for the confirmation, look for the reaction, and that's it. Very, very nice. Very nice. So on the higher time frame, that we're bullish doesn't mean that we have to wait all the way to long from here. No, not necessary. The only thing that we have to look out for here is to wait right now. If on the, let's say, 4 hourly right now, I use the 4 hourly most of the time. Because we created a break of structure to the downside here. Let's clean it up for you guys. We created a break of structure to the downside here. Then I changed character to the upside, right? So I validate this one as a swing high to swing low to swing high. But if we now break this low, so if you take out these lows here, right? Then I see something different. Then I see something like this. Invalidated. Breaking these highs here. Right? Then I'm gonna look for shorts. Does it make sense to look for shorts then? Potentially, yeah. Head and shoulders, one of them. The other one, higher time frame. We are still not in the equilibrium. We are far from the equilibrium here. Right? We still have the 50% here. We are not there yet. This is what we're looking for. So yeah. If we break these lows then, and we come back up, then we look for short, we're gonna take it to the equilibrium, or take it to the 62 or 70.5. Then we can start thinking about closing our position and potentially looking for longs again. But for now, we are still looking for longs. Why? We have not proven to show us any signs of weakness on the lower time frame. So that's what we're looking for, man. I hope that answers your question, my man. We're gonna nail it down. We're gonna close down very soon. And let's talk about the actual setups we're looking for. Okay, let's get back into the present. But in these are beautiful opportunities we can still look out for. But now you see how important market structure is to understand, to determine your bias, right? And based on that, you can easily determine the Fibonacci. And based on the Fibonacci, you can easily determine the order blocks. And so on. And like that, you can narrow down and go all the way to the 5 minute, 10 minute to look for the perfect, you know, the higher, like the actual confirmation. And the beautiful setups right there. Okay. So what do we have? We have the DXY here right now. Let's go to the DXY. Okay. Wow. Okay, there's one last chance for the DXY. This order block right here. Okay. This is the last chance. Why? Because we broke the lows here. But if you create a higher high, then you know what's up, right? So right now, if we come back up and break these highs, then we can continue the way up here. And then we are bullish. And then tomorrow we're going to look for USD, COD. We're going to look for the USD Japanese yen. We're going to look for all these long opportunities there. Okay? Continuation patterns right there. Continuation trades. If we see it break right now, that could be very interesting. Why? Because gold comes into play. Gold comes into play then. And what's the range for gold? The 62% of this order block. This retracement right here. So then look for the continuation, look for the higher high, come back into that area, tap into the zone, create a higher high, boom. Take off from there. That's what you want to see. Okay, that will confirm your trend. Because what is the rate hike, what it actually means? Well, it means that people are going to sell their assets and put it into the dollar. That's potentially the reason why the VIX right now is, I think, pumping. Oh, wow. There we go. Okay, the VIX, boom, exactly. We know exactly what's up here. So we have broken this, we have invalidated that zone. Invalidated this one. This one. This order block. And it makes sense because the higher time frame was always bullish, right? Not bearish. We were only looking for the shorter reaction here. Right? Break stocks to the downside, change character to the upside. Boom, came back up, tap to the zone. Again, took off from there. Continuation now. Now it's a continuation. Again, continuation. Which one? Fibonacci, swing low to swing high. Where did we end up here? The 62. Lower time frame. There we go. This order block right here. That was the order block. So the continuation was there. Makes sense here. Okay, that means that the NASDAQ right now is probably melting. Completely. Okay. Yeah, wow. Yeah. Okay. Okay. Yeah. All right. Then it's very similar to the indices right here. Very, very similar. Swing high, swing low to swing high. Tapped into that range. The question is right now, are we gonna create a lower low? Are we gonna take out these lows right there? If so, then this is the confirmation for potentially continuation to the downside. That's it. But this is the level we're looking for. 11,061 is the level we're looking for here. Okay? On the higher time frame, what do we see here? The last time we took out the swing low here, and we had the break of structure here, was in 2019 there. Right? We came like back up all the way. We were massively expanded already. Massively expanded. Swing low to swing high. What are we doing? Okay. 50 is not gonna be it. Alright? The next one is the 62 here. So the next one is this particular order block right here. Right there at the 62. This is the next layer. So if we tap into that range and we come back down here right now, then the question will be, are we gonna take out these lows here? That's the question. If we take out these lows here, of that swing low to swing high, we have taken out the swing low, confirms our zone. Okay? Any retracement back up is a short opportunity, looking for shorts here. Then we can start zooming in right now, and you can still look for the continuation. Very similar. So now we're at the 1 hourly. Change the character to the upside. To the downside. 30 minute. This could be for tomorrow. Continuation to the downside. There we go. Continuation to the downside, guys. Targeting these levels here. Okay? Targeting these levels here. Does it align here? Definitely looks to be aligning here with the VIX here. Okay? It's just a significant level here. We have that zone. The only hard time we're gonna look for the VIX here is potentially liquidity is built up there. Somewhere in this range. We need to see. We need to see what happens here. But it's somewhere in that range right there. Yeah. So there is still definitely some downside potential. Enough downside potential here for the US 100. Now we massively broke structure here. So I'm definitely looking to continue the way down. And to start looking at that range. To come back down to that area. Okay? Targeting these levels here. First of all, this massive order block. Right there. Okay? At the 62. I think that one sounds very, very reasonable. We have been bouncing again around the 50 for a significant amount of time here. Alright? Couple months actually. And now we broke it. And if we create a lower low here. There we can definitely look for these ranges. So this is going to be a very crucial zone. Okay, we're gonna see some support here. It's not going to be easy. We're going to see support here. We're going to see support there. We're going to see support at multiple levels still. Okay? But that doesn't mean we cannot short it on the lower time frame right now towards these levels. So anything above that range, tapping into that area, can look for the short continuation right there. So these are beautiful, yeah, quite significant opportunities there. Right now, the confirmation is on the 3-minute here. There we go, guys. Same thing here, right? It's a fractal market. There we go. I hope that that answers your question right here. We can look GU as the last trade pair. But that's totally gonna depend on the DXY here. It seems that we're gonna break it. We don't know for sure, but it looks like we're gonna break it. It would make sense here in the midterm, right? That would be extremely bullish for GU. Bearish for GU, sorry. We have never taken out these out, so we can easily create lower lows here. I don't know why this was here. So yeah, daily continuation to the downside. It's very simple. If you zoom out here, what do we see? You guys know what's up. We saw the change to the change character to the downside. Then to the upside. Then we invalidated the zone here. We invalidated that. So right now, it's very clear that this is the swing high still. The swing low. On the weekly here. However, on the lower time frame. And that look at the DXY, we're still in a massive bearish momentum here. Okay. But then the question is, what was the last time we broke structure to the upside and then moved down further? That was here. Okay. That was about around this range right there. Right here. This is where it eventually happened. So this is the swing high. This is the swing low. So looking at the lower time frame, 30 minute and so on. Look for continuations above the equilibrium. Let's zoom in a little bit more. Liquidity has been taken already. Okay, this high is not created yet, so low is not created yet. So what are we looking for? This is the last zone. So this is the range. The equilibrium is the first area here. That's why we saw that reaction already. That's why we saw this as a reaction here. Beautiful aligning here. There's liquidity above this range. So pretty much what we're looking for is the continuation. Okay? Coming back a little bit higher, take out one of these zones, stepping into one of these ranges, and just continue the trend to the downside. Either here, or either a little bit higher towards the 79. We need to see right there. Okay? Very, very simple continuation there. The USD Japanese yen is very clear. Oh, wow. Wow. One hour. What did you see here? Came back down, higher high. Tapped into that range. No higher high. This is exactly the reason why you don't want to long there. Because of that higher high that you created. Or not, we didn't create that higher high here. Same here. I usually would not trade these reactions right there. However, what do we see right now? Wow. This order block is legit. Why? It came down. To the upside, retracement back into that range. Tap it to the 5 minute. Maybe even lower. This is a potential trade here. Looking for the continuation there. Way to take out these highs here. Once we've taken out these highs here, any retracement is then good to potentially look to determine what the Fibonacci will tell us. Right? So let's say we take these highs where price comes up here. Come back up. Come back down. Tap into that range. And then take off from there. Because we have then a clear zone, we can draw the Fibonacci, of course, from swing low to swing high. Let's say we create these lower lows here. Do we see an order block that it is intriguing us here? Let's say we break these highs here, like here. And we have this one. What do we see here? Beautiful order block. So we're definitely long here, potentially from 143.674. However, we need to create a higher high here. We need to tap into a premium area of demand here before we start looking for ranges. That's why these highs are so super important to be taken out there. That's what we're always looking for here. Right there. We're getting close. We're getting close. Especially if you take out these highs here. And we do know it aligns here. Okay? Okay, let's say I'm thinking. I think gold will drop to mitigate the 5-minute OB that's inside of the 50-minute OB. Okay. I thought it's a 3-minute actually. So we have this order block here. The gold one is at 1666.9, and the stop loss could have been at 164, pretty much. However, be very careful. One more time, let's have a look at the DXY here. That's significant right here. I wanna wait at least for a significant closure if you wanna go against the dollar. Okay, the closure has to be here. Why? Because then you're looking for this. You're looking for that opportunity there. Alright, from that moment. Right now it's this, right? Break of structure to the upside. Change of character to the downside. So now we're here. Now it's still potentially shorting, right? However, if we break it, then it's of course invalidated. So what you want to wait to do if you want to go against the dollar, you want to create a lower low here. Okay? And potentially create a higher high first. Higher high first, lower low after. That will be the perfect scenario. Okay? Higher high first, lower low after. If you don't create that, I would not take this gold opportunity here. maybe for a scalp. A quick scalp, could align them. But that's pretty much it. Guys, I'm gonna head out. Thank you so much for today. FOMC meeting, very interesting. I personally, purposefully not traded. Okay. However, there are many layers that we're doing, that we're going through right now. The analysis are very clear. We know exactly what to do, where to wait for the DXY and so on. I'm gonna go to bed straight away. But tomorrow morning, when I wake up, I'm gonna update you guys instantly in the Meta charts as well. So if you want to be part of our Discord channel and join our almost 4,000 people, welcome Keegan, by the way. Almost 4,000 members on our Discord right here. Want to be part of a beautiful community? Then you will find all my setups, all the things I'm talking about, all the trading ideas in here, including the scalping setups as well at the same time. All right? All the trading ideas are here as well from our verified traders. Somebody asked what you need to do in order to become a verified trader. Try, post, and put your input in here on a regular basis. Show me that you have a decent understanding of market structure using SMC, and then we make you a verified SMC trader. So thank you guys so much for today. Yeah, we're gonna keep keep progressing here. Okay, keep analyzing here, and this is what we're looking for. We're looking to scalp live. However, at the same time, we're looking for the higher risk reward setups right now. You know exactly what the approach is. From the monthly, weekly, daily, all the way down to the 1 minute if you're looking for opportunities there. Okay? This is what we're looking for. This is what we're gonna do on the live streams on a regular basis. Right there. So, we're gonna catch some beautiful trades in the future, guys. But the most important thing is that we understand why we are taking the trades. Then I'm gonna keep repeating for you guys, so you guys can understand it here. If you want to get a little bit deeper every single day, ask questions right there. Go even the things there to take things to the next level based on the market structure I'm explaining to you guys. And also the Discord right there. Links in the description. It is 5 a.m. I'm gonna head to bed. I love all of you guys. Thank you for being part of our family. We're almost at the 10k subs here. I appreciate that as well. You know what we're gonna do when you have the 10k? We're gonna do this for 24 hours. Alright? I'm not gonna stop, guys. I'm not gonna stop. I appreciate all of you. Have a wonderful night. Or day. And I'll check you tomorrow. Peace out. Bye-bye.